Hey all, in the world of investing, that's one name that stands out. Yes, that's correct. Warren Buffett. What if I told you that you can follow in the footsteps of the legendary investor? Imagine having a checklist that can help you make smarter investment decisions just like Warren Buffett. I'm going to present Buffett checklist, a set of criteria that has guided Buffett's investments for decades. With this checklist, you will learn how to identify excellent businesses and invest with confidence. Are you ready to uncover the secrets of Buffett's success and take your investing to the next level? Get ready to master the Buffett checklist and unlock the potential for profitable investments. And this is Sundar and you are watching Warren Buffett had a very simple concept. Your investment has to be very simple. Make it complex. When you start to make complex, it becomes very difficult and tedious jobs. It's supposed to be simple. For example, there was a conversation between Warren Buffett and Bill Gates. During the conversation, Bill Gates asked Buffett that, why are you not focusing or investing in tech stocks? For that, Warren Buffett replied, my concept is very simple. Technology stocks are too much volatile. So there's a lot of risk involved. I don't know the business about technologies. It might be innovative, it might be the future, but I don't have clarity about what is this all about. He clearly mentioned that only I will invest in a business which I have knowledge. An example is, he asked Bill Gates, will you stop drinking Coca-Cola? For that, he answered no. So that's the thing. I know about Coca-Cola and people never going to stop drinking Coca-Cola, and they have a very good vision in their business. They have good strategy. Currently, they are going across the globe to incorporate the brand. So I choose stocks which I personally know and I believe in those kind of stocks can go long run. So that's how your investment plan is supposed to be. So that's why this checklist is followed by Warren Buffett, and I'm going to present this checklist and you can also follow this checklist. This is very simple. I'm not going to get into the technical things. Maybe in the next video I can detail about few technical things which you have to look into that, but this video is mainly for the beginners who wants to start the investment and they want to pick stocks in a simple way. So let's jump into that. The first and foremost, consumer monopoly or commodity. Find a company whether it is a consumer monopoly or commodity. You need to have clear understanding about this category. What is consumer monopoly? Consumer monopoly is something that they have a unique product and there's no competitor or less competitors. They have pricing power and have higher profit margins. The other hand, when you talk about commodities are something like it could be a product or service, but it is available vastly. The demand might be there, but the volume might be more, but there will be less margin. So find the companies which are consumer monopoly and focus on that. Take an example of Asian Paints. I want to take Asian Paints. You can easily relate to the stock. So Asian Paints is a top company in paint manufacturing. They are kind of a monopoly. They might be having a competitor like a Berger Paints, but still Asian Paints like a monopoly. Their business is very clear. The other hand, if I take Coal India is a commodity-based thing. It might be might be having a huge market value. But if you take, so Coal India might be a market leader and in their specific industry, which is like coal mining. But not just being a monopoly makes any sense. They should have pricing power. Since it's a public sector, government owns most of the things. The decisions are taken by government. So most of the time, the pricing power is driven by the government rather than promoters and the executives. Just make sure to evaluate the company's competitive nature and its pricing power. Now the second one, understand how business works. As earlier in the intro also I mentioned about the Warren Buffett's conversation with Bill Gates. You should know what that company is doing, what is their all business is about, understand their business model. You should be able to easily understand their competitive landscape, analyze the company's value proposition. For example, if we take Asian Paints, their value proposition is R&D, reach out to all type of consumers, innovative in their paint. So their value proposition is very clear. And you also know very easily that this is what the Asian Paints is working towards. And their unique advantages is they are the monopolies. The second thing is assess how the company generates revenue. In Asian Paints, they have a very good service in supply chain. They have 100,000 outlets. The supply chain is such a way that if a demand is created within an hour or two, that particular outlet will have that. That particular outlet will have it in their warehouse. So that is the power of supply chain they have. The network, the delivery network which they have is tremendous. So that shows how Asian Paint is powerful in their supply chain. And understand their nuances about the complexity involved. What are the complexities like you feel in the business? For example, in Asian Paints, the complexity could be the R&D, the future, what is going to be, how to be sustainable, work towards sustainable product. Right? So they should know long-term vision and work towards that one. The long-term vision is about sustainability, and Asian Paint is working towards that. On the other hand, if you take Coal India, the problem is they are working towards a lot of the futuristic thing. They're diversifying it, but the whole business is coal mining. So understand that if the coal industry goes down, they have to invest in new companies. Their business has to be new, so they have to do a lot of R&D on that part. But is that sustainable? Who knows what will happen to the coal industries, right? So choose your own industries and understand how it works and what is the business is all about. The third thing is the company conservatively financed? What does that mean? Find out that the company is able to solve their capitalization problem by themselves. Evaluate the company's financial structure and capitalization. What is this mean about? What is this conservative finance is all about? Look for conservative financial approach, the reasonable level of debt and healthy balance sheet. It's a little bit finance related things, but overall, they should know how to run a business with their own money rather than getting from a debt. Basically, you need to be able to assess how the company can manage their debts, how they are going to repay their debts. If the company is able to finance conservatively, that is considered as a safest stock. You have to find out debt-free stocks. I'll just slightly touch upon some technical things. It might be too much for now, but if you can understand, it will be good. So let me show you that. So let me show you two websites where you can browse the stocks and explore their properties. One is screener.in, and the next one is ticker tapes. So mostly I go with the screener.in, but sometimes to compare or filter, I go to ticker tapes. So let's see what is this debt to equity means. So in the screener. You can browse all the stock details. If you go and see in the header debt to equity, which is given as a 0.12. What does that mean is the total debt divided by the number of equities. So how will you find this one? So if you want to find out how much is the equity, you just find here, which is the balance sheet you can see, which is share capital, which is 96 crores. The total number of share is 96 crores. If you go to ticker tapes, click on the large cap, it's here. If you see 1,932 crores. So this is the debt. So total debt divided by number of shares, you will get 0.12. So which means what it says is 1 rupee of a debt can be paid by 0.12 rupees. So that means it's a good company. So whenever the debt to equity is less than 1, you can say that this is a good company and the debt is low and the debt can be easily managed. That is the main crux for here. So you need to understand how a company can close their debt. So that is what this conservatively finance is all about. So you should know how the company is able to pay their loans and debts. If they have more loan, so make sure to be careful and away from that company. The fourth one is, are earnings strong and do they show on upward trend? That means analyze the company and find out whether their past earnings are in uptrend. For example, if the last year is 1,000 crore, now this is supposed to be like 1,200 crore. You have to find out the earnings, whether it is growing or not. And this should be considered for the last, at least for 5 years. And make sure the key drivers for companies earning is from what point, what is the source of it. So is it the same business which they are doing or from other different business? For example, if you take ITC, their core revenue or core earning is coming from tobacco. They still own hotels and they have a business from retail, they have business from agri, but still the whole revenue comes from tobacco. So you should understand from where the revenue is coming from and what is their sustainable growth on that, whether in the next 5 to 10 years, where the company would be. So just make sure to check those things and find out whether the past earnings are consistent or it's volatile. Is it up and down? So make sure it is consistent and the earnings are growing organically. So if you want to check about that, I'll show the Asian Paints growth here. Just go to the screener.in and check how their profit is. Sales volume is increasing constantly. Their operating profit is increasing constantly. Right? So that is how you have to check how their income is from where they are getting the revenues. If you go here, as I mentioned, the ITC, let's go to ITC. So this is their ITC revenue. If you see, it is constantly growing. Right? So you can see the year-on-year growth over here. So just be simple in selecting the stock by this simple value. So don't complicate yourself. The next one is, does the company stick with what it knows? What does it mean? Understand that the company's strategy has to be focused. It need to have a proper strategy. If you take Eicher Motors, their whole focus and strategy is building a 220cc or 300cc kind of a bike in Indian market. Their vision is very clear and they are focused towards their vision. The company should run based on its basic fundamentals or its core knowledge. If, for example, Infosys is a service company. If they want to manufacture a laptop, is that a possible one? It's a very easy to no-brainer question, right? So that is how it's supposed to be. A company charted based on a certain fundamental, and whether they are sticking to their same fundamental. An example of Paytm. What is the Paytm strategy? It's supposed to be a payment gateway or payment provider or UPI provider or digital transactions. But problem is their focus got diverted. They tried to diversify, but it actually diverted. It got polluted. They started to do bus ticketing. They did Paytm Mall, movie tickets. Now they are into investing, mutual funds. They're doing a lot of things. But the whole thing is digital transactions. How to make digital transactions effective. That's how what is their expertise is about. But now they are keeping their foots in different sectors and different things. Who knows what will happen, but think about this one. When you're choosing a stock, it has to be very simple. It should not complicate your life. Asian Paints, they know what they are doing. They are a paint company and they are looking for long-term how to grow their business in sustainable way, how to bring more different colors, different aesthetic, different patterns. So they even provided a paint service. So think about this. They do what they know and they are sticking to that. That is how simple it's supposed to be. If there is a slightly dilution, please, I advise you to not to touch the stock. Our portfolio can have 5 to 10 stocks or maximum 20 stocks. So in that, choose a stock which comes under this kind of a basket, this kind of parameters. Don't complicate your life. So it's a basic understanding that a company sticks to the basic expertise, what they know, that company will go for a long run. So that is the whole concept of this particular point. The next one is, has a company been buying back its share? So just check the historical data of the company, whether they have ever done the buyback. So what is this buyback is about? So when the equity is released in the market, that means company is getting the money from the real investors and they are using it. What they does is they buy back the share, which means they try to show that the company has more potential to grow. So they have confidence that they buy at a high price to show that the company has a growth potential. And the company says that or project that the current price is undervalued. So the company is trying to buy at a lower price. And during this time, we can assess the company, find out whether the really cheaper, it's really undervalued. You can go for buyback, you can sell the stock, and again you can wait for some time when it dips, you can go and buy. So you can use this opportunity to book a profit. Normally they buy at higher than the market price. So you can sell and then you can wait for the market, how it behaves, and then you can re-enter again. But whenever these things happens, make sure to assess the impact, because when the buyback happens, the number of stocks in the market reduces. So your ROE may change. So what is ROE? ROE is return on equities, which means when the investor is giving say 100 rupees, how much revenue the company is bringing. So I'll just show the data here. What is ROE? ROE is return on equity. What does that mean? As an investors, we pay money. That money is being used by the company. And by that money, what is the revenue they are bringing? For example, if we pay 100 rupees, the 100 rupees, what is the revenue company is bringing? So when you say 27.7% as an ROE, which means for every 1 rupee, company is bringing 0.27 rupees. Understood? Very clear. So don't complicate yourself. Just look at this value. So basically ROE means how efficiently company is using our money. So that is what ROE is about. So here it clearly says that for every 1 rupee, so company is able to bring 0.27 rupees. More the number, so good the company is about. Let's see what is Adani is doing. Let's go to Adani. So guys, just understand that whatever I'm talking about here, if an example is given here, it's not an investment idea or investment advice. So this is just for education purpose. I'm just referring all the stocks just for and reference, and there is nothing to do about recommendation or anything. So if you see here ROE, which means what is the revenue is giving? For every 1 rupee, the company is able to generate 0.09 rupees. What was Asian Paints? 0.27 rupees. So that is the difference. So basically after the buybacks, there are chances that the stock may go up. Basically after the buyback, there's a chance that the stock may go down for some time. But based on the other parameters and everything, make sure you can re-enter and repurchase your stocks so that you will be, and when you see that kind of a momentum in the stock, then you can feel that this is a good company. It will go for a long run. So next point is, have retained earnings been invested well? What does this mean? So you have to make sure that you have to evaluate the company, how they are utilizing their earnings. So for example, most of the companies like the public sectors, Indian Oil Corporation or Coal India, all those companies, what they does is the earnings will be given as a dividend. So this is another point that all dividend paying companies are not good companies. Okay, just understand that point. So sometimes dividend is good, but not always. The main thing why the company gives as a dividend is they don't know what to do with the money and they have to give some kind of a return for the investors. That is the main reason they'll give a dividend. Otherwise, people will sell the stock and they go off, right? If the return is less than the fixed deposit, people will not invest. So that is why they keep the public sectors, the stock price may not go up. The main reason is they keep on giving as a dividend. So just make sure the earnings are reinvested properly. If not, please get out of stock. Another best example is Google. If you check Alphabet company, they never pay dividends, and they show that in the growth of their stock. So that is how they repay the investment. And as the company has reinvested in a profitable way, some company may acquire a new company. For example, say Asian Paints, they acquired a company called Berger International from Bangladesh. That means Berger International is the biggest company in Bangladesh, and they bought that company, they acquired that company so that now they can expand their company or expand their growth in different countries. So now they are trying to expand in Bangladesh. So that way acquisition has to be very much clear and very simple to understand, and people should be able to map the company's goal and what the company they are acquiring. It should not be some random company and they acquire and they lose the money. Sometimes the profit, the earnings will be shown as an investment or acquisition, but you need to be very careful why they are doing it. Sometimes they might be investing in some stupid company and you won't get anything out of that. So that is very important. The next one is the company's return on equity above the average. So we discussed about the return on equity. What is the return on equity? We just discussed. So same thing. To make sure the company's return on equity is above the average. That means you have to check with the peer companies. For example, I'll show the example of Asian Paints. ROE is 27.7. Now scroll down, you'll see peers, right? So Asian Paint, see ROE is 27.74 and the peer companies are Berger Paints, all those things are there. You can see what is their ROE. Asian Paint is good. You can clearly see that. So that is how you have to check how this works. So ROE has to be again compared with the peers and understand that how this particular company is performing within their sectors, right? So here example I just shown the Asian Paints. Similarly, every industry will have their peers. So just make sure that ROE is higher than the average. The next point is the company free to adjust prices to inflation? This is a very important one. This is called pricing power. A company which has a pricing power can sustain for a longer durations and you can bet on that company. What does it mean by pricing power? And so before that, you should understand what is inflation. Inflation is something that the value of money is reducing. Just go back and check 5 years back or 10 years back, what was the price of a tea? I used to buy tea for 2 rupees. Now it is 20 rupees. It's not the growth. This is called inflation. So every year there will be a inflation. Your money value is reducing. So during this time, whether that company is able to increase their price. Take an example of Hindustan Unilever. You might have seen that the biscuit you purchased earlier might be like 100 gram would be 10 rupees. Now the price might be 10 rupees, but they would have reduced grams to 80 grams or 60 grams. Or there are chances that the same 100 gram could be priced at the level of 15 rupees and still we will buy because it's the staples and all those things are essential needs, right? So FMCG sectors are the one, they have very good hand on pricing power. Even take an example of Apple. Apple has complete control of pricing. Initially the phone price the mobile price used to be something like 60,000 or 70,000. Now it is going to 2 lakhs, 2.5 lakhs, but still people buy. That is the time the company has to perform well and they should be able to raise their price and the revenue also will increase. The sales might be same, but their revenue will increase. That will adjust. That is the concept of this particular point. If you take an example of Gujarat Gas, it suffered a lot because these public sectors are something that driven by government. They will set the price. The independent company cannot set the price. So in that case, even the running capital, the raw material costs are high. They are not able to sell with the price they wanted because government drives that one. So that is why mostly I avoid the public sector things. It's my personal opinion. So normally I avoid the public sectors so that most of the public public sectors are not a growth stock. So just keep in your mind and have a tab on this particular thing, how they are able to price their product. Mainly assess the companies based on the strength, the strategy, how they plan ahead the next year. For example, this year war happened. During the war, there was a huge drop in the market, but still few companies able to grow back very fast. So that is the power of brand. Some brands are there, even if it falls, it will recover. Example is Nestle. Nestle is a very essential need, the product they create, right? Everybody buy that. Politically, there are a lot of different opinion might be there, but everybody buys Nestle product. And if you go and see the growth of Nestle after the COVID, it's tremendous. So you have to check those kind of brands and invest. The last point is, does the company need to constantly invest in capital? What does that mean? Find the companies which are heavy in infrastructures. For example, Tata Steel. Tata Steel company is similar to not only Tata Steel, Tata Motors. All those companies are purely driven by their capital infrastructure. Their infrastructure needs lot of capital. Every year when new trend comes or new market comes or new technology comes, they have to upgrade the technology. That way, every time they have to reinvest their money or earnings to build the infrastructure. That is why recently Tata Motors, what they does was they reduced the different types of vehicles and they made similar body line. The body is same, but they manufacture different models. So that way they reduce the production line and they are trying to reduce the operating cost. That is how some company will try to solve the problem. Make sure your company is, whether it's a capital, whether it needs more capital to run. Not only just Tata Steel, you can check a lot of companies. Please subscribe my channel if you are interested and post your comments and I'll reply back. Just make sure to subscribe and press the notification button. So otherwise, you'll miss a lot of topics. I'm planning to have a couple of more videos coming forward. So this is the beginning for the beginners, and going forward, this level will increase and you will be finding more interesting. So don't forget to subscribe and press the notification button. So just I want to say that if you have any idea, if you want any clarifications, you can post in the comment also. I can create content based on that as well. So now coming back to the point, this checklist is like a Bible. Keep it. This checklist, you can take a printout, paste it in your wall or something. Whenever you want, just look at that. It's like a guiding principle. If you pick any stock, just use this checklist and try to find out which one's matches. At least your score needs to be more than 7 to 8 out of 10. If it is less than 7, please don't go for the stock. Just make sure this particular topic is, there are n number of companies over there. It's very difficult to find out good companies, but using this checklist, you'd be able to round off a square off in a very fraction of times. In my next video, I'll guide you how to pick stocks. Stay tuned and do your investment mindfully. Thank you.